All right, welcome back to the show to talk about oil, gold, and much more. Rick Rule is back with us. Rick is the CEO of Sprott U.S. Holdings, also an expert on natural resources investing. Oil prices rose about 7% last week, driven by cuts in energy production and a weakening dollar. But major energy stocks struggled as analysts like those at Goldman Sachs have said they expect oil prices to go down. So I first asked Rick where he sees the market over the short and long term. Here's what he told me.
With regards to oil prices, I think Goldman Sachs is right. I see a global lack of demand for just about everything worldwide, and I see too much oil trying to come back on the market, Iranian oil in particular. Also, the budget cuts that we've seen in the oil producers haven't worked through enough supply destruction yet to firm up the oil prices. With regards to the oil equities, my suspicion is if you're going to own them 5 years from now, you'll be happy owning them today. If you're going to own them 12 months from today, they probably go lower before they go higher.
Well, we've got an OPEC meeting on a potential production freeze coming up this weekend in Doha. Some interesting mixed messages at hand, with Russia taking a pretty bullish stance on an oil production deal. Saudi Arabia then comes out and says it won't join a freeze until all countries, including Iran, gets on board. Then Kuwait comes back and says that an agreement must be reached at this meeting. And so you really are getting mixed messages. I mean, to what extent do you think that the differing attitudes regarding a freeze are confusing the market here?
I think the freeze is a fraud. I don't think that they'll be able to agree on anything. I don't think they, in particular, have any incentive to agree on anything. So my suspicion is that those countries that have no choice but to cut production, places like Venezuela and Mexico that haven't made sustaining capital investments, will in fact cut production, not because they want to, but because it takes itself lower. Countries that have the ability to continue to produce for cash will do so too. I see oil prices stable to lower for a while.
So, I mean, do you think Iran, or countries like Iran, Iraq, will pull back, or not in the least?
I do not. I think they will continue to produce to their capability and produce for cash. Oil is an important part of the national budget in those countries, and politics is a full contact sport there like here. They need the cash, simply put. They care more about domestic political expediency, than they care about cohesion in OPEC.
So is it a deal if they're not on board? I mean, can you say there's even a production deal without countries like that, countries that are mega producers, without them on board?
I think there may be an agreement, Amira, but we've seen in prior down markets that the agreements don't mean much. Everybody cheats, everybody intends to cheat, and everybody knows that everybody else is going to cheat. There may be some grand political statements, there may be some hugging, some glad-handing, but I don't suspect that anything will come out of it that isn't supported either by production destruction, that is, the destruction of countries' abilities to produce because of underfunding, or a recovery in demand. And it doesn't look on a global basis like there's any sustained economic recovery at hand.
Well, how does a retail investor navigate this oil price volatility? I mean, where do you see the most opportunity?
I think the most opportunity will come up towards the end of this year in the junk bond market. I think we're going to have a train wreck of historic proportions in the junk bond market. My own suspicion is that this year's very low oil prices will wreak havoc, both with regards to the net present value of companies' reserves, but also their margins. I see a lot of problems in the senior energy credits, and of course the junk debt is all subordinated to the senior credit, My own suspicion is that 3 or 4 years ago, when this debt was sold, it was sold to buyers who were yield conscious, not credit conscious, meaning in their math, a bad 8.5% credit was better than a good 7% credit. And I think that that conjunction of poor investment decisions, constrained margins, and bad net present values, beginning in the third quarter of this year and extending all the way through 2017, will really roil energy junk debt markets. And as a consequence of that, the equity markets in anything smaller than the very, very largest producers. And I think this will set up an 18-month-long, once-in-a-decade opportunity for energy investors. But going into it will be very treacherous.
Right. You mentioned the equity market. I mean, let's talk about the stock market for a second. The S&P has rallied by 12% since hitting a low in February. Some analysts, however, have said that much of that boost can be attributed to traders who are simply closing out earlier bets that the market was set for a big fall. They say short sellers are selling securities with the intention of buying them back at lower costs, also known as short covering. And they say that has temporarily pushed the market up. And that we should not get too excited about what we're seeing happen in the stock market. Do you agree to a certain extent? I mean, how bullish should we really be on equities?
In the absence of top-line growth for these companies, I'd be nervous about being bullish over the 2 or 3 year time frame. Margins, at least with regards to U.S. companies, S&P 500 companies, are at historic levels. I can't see the margins getting much better. I think the thing that's really holding the stock market together are extraordinarily low interest rates, people being forced into more speculative investments, and also people chasing the yield in stocks rather than yields available other places. If we saw an economic recovery, it would be interesting if we had an interest rate rise to see the impact of that on equities. What I would say to your listeners is not to pay too much attention to the stock market, but rather to pay attention to the prices of companies that you like and understand. Divorce your investments from the market and invest in companies, public or private, not so much in stocks.
That's very interesting. I mean, let's talk a little bit about gold, because this is something you've weighed in quite a bit on in recent days. And this is a commodity that, if you look in the past, has tended to move counter to the stock market. In this case, though, gold has managed to hold its massive gains through the latest stock run. So what do you make of the resilience there?
My suspicion is that gold and gold equities have put in their bottoms. You need to be a contrarian investor to be in the gold business. It requires a cast iron stomach. Contrarians learned that you want to own things that are unloved, check, that's gold. Underowned, check, that's gold. But in an upturn, because timing is important, check, that's true with gold too. With regards to the natural resource complex, I think that precious metals, but particularly gold, has bottomed and is in an uptrend.
When interest rates, though, go up, it's expected to weigh on gold. So is there a cause for pessimism on the gold rally?
Well, I can always make a negative case for gold, but it's interesting that you bring up interest rates, Amira. I came into the gold market in the 1970s. It depends on why interest rates go up. If interest rates go up because investors anticipate that the purchasing power of the principal that they have is going to decline, then interest rates can go up and gold can go up. If you go back to the 1970s, the gold price went from $35 an ounce to $850 an ounce, even as the interest rate went up dramatically because of the anticipation of poor performance of the purchasing power of the underlying currency. And I think the situation that confronts us today is very similar.